Well, the market's coming off a record high in 2019. The earnings per share, or rather, PE was about 18x. But is that too high? Ben Mandel, global strategist at JPMorgan Asset Management, joins us to discuss why he expects the 2020s recovery, or expects this year, the 2020s recovery in economic activity to be more tempered than the rebound in 2017. Let me put this in simple terms. Yep. I'm looking at a market that looks kind of very expensive, and a lot of people afraid, frothy, to come in, because when you look at forward earnings, we're at 18x, and people say, hey, that's expensive. So what's going to take us even higher?
Okay, so it's not going to be, first of all, I'll agree with the underlying premise that things are a little expensive. U.S. equities, large cap, looks expensive by its own historical standards. However, as we're thinking about the world over the next 12 months or so, and we see an underlying improvement in fundamentals, we think there's room for not necessarily multiple expansion, but for earnings to drive equities higher from here. There are a lot of important caveats to this idea that U.S. stocks are expensive. One of them is that multiple expansion that we saw during 2019 was predicated on easier monetary policy, right? So we don't expect a repeat of that massive swing that we saw in 2019. Keep in mind, at the beginning of the year, we thought there were going to be, or markets thought, there would be 4 hikes in already priced into the curve. You swung to 4 cuts, right, by midway through the year. You're not going to see that extent of easing. However, we've locked in a lower level of rates, and we expect those to be supportive of multiples where they are at present. The other thing is we have to take a step back and say, from a global perspective, put yourself in the shoes of a global multi-asset investor, not everything's expensive. And so as we look at the global opportunity set within the equity space, we've been adding to areas where valuations are not screaming expensive.
Like?
So, for example, emerging markets, right? So what are the areas that were hit hardest by the major challenges to markets in 2019 and to the global economy, and where, in principle, they're most levered to sources of improvement in that macro environment? And so emerging markets, compared to its own historical valuations, looks roughly fair.
I know Oliver thinks it's a little early, though, to get into emerging markets.
Yeah, our concern with EM continues to be that it's a value trap. And yes, the valuations are lower. I don't think they're all that cheap, but they are lower. There's no question about it. But there's a reason for it, and there's still a lot of uncertainty. And so when we look at things from a risk-adjusted basis, from a U.S. perspective as U.S. investors, which is where our clients are domiciled, we think that Europe and North America are much more attractive, with some pockets of opportunity in Latin America compared to
So I think you have to, I think horizon is important here, right? So over the next 12 months and over the next 10 to 15 years, we're actually seeing a bit of alignment in this idea that emerging markets is appealing. Valuations is one source in our view. Second is growth, right? As we look at trend growth for the globe, we see the U.S. at about 1 3/4 real GDP growth in trend terms. Emerging markets is about 3 percentage points higher in trend terms. And so there's a valuation tailwind in the near term and in the long term, and it's those growth, the growth dynamics which I think are ultimately going to prevail.
So Ben, sounds like sort of your thesis coming back to North America is somewhat contingent upon earnings growth. And there's a big debate, of course, this time of year. High end, like 10%. Is that what you need to make your dreams come true?
Well, I think it'd probably take more than 10% for all
Okay, good. Yeah. Don't sell yourself short.
However, I also don't expect all my dreams to come true in 2020. So I think.
What number are you looking for?
So this is we're looking at sort of mid-single digits as something that's perfectly reasonable in the context of an economy which is growing at roughly trend. You have inflation, which is at roughly trend, and you have some support from buybacks and other distributions. And so in total return terms, that's enough to get you to a middling outcome, but slightly positive and better than we are right now, to be sure. So I guess that's going back to your original question. This is not 2017 where there's a lot of cyclical juice in the global economy that's going to give rise to a big synchronized upturn in earnings. That said, we expect things to grind higher, and not only that, but expectations have been coming down. And so we have consensus, you say at 10%, but it's been drifting down over the last couple months.
That's the high end, but it
sort
has
of
been going
upper single digits, which is doable.
Okay, Ben Mandel, thank you for joining us, JPMorgan Asset.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.